What is up, everybody? Welcome back to Bitcoin and Markets. My name is Ansel Lindner. Happy Friday out there. Hope you guys are all doing well. Today, I wanted to go over a new video that was just released by Real Vision, and Luke Gromen was on it. And if you guys know me, I disagree with Luke Gromen on almost everything. But, you know, I have respect for him. He's not a scammer. He is actually out there trying to provide value. And so I highly respect him for that. And, you know, his content and everything out there is more successful than mine. So I always have to take that everything I say with a grain of salt. But we're going to listen to that interview, play it here on YouTube. Telegram, you're listening as well. I'm going to share my screen for that. What else? The main idea here is peak cheap oil versus peak oil demand. I am on the peak oil demand side, and I think Luke knows that. He's aware of me because I've interviewed him for Bitcoin Magazine. We interviewed him back in March of last year, 2022, right at the top of the oil price, WTI oil price. And he was saying it's going to 150, 200, whatever, is going much higher. And of course I said, well, what if the top is in? And the top was in at that time. It was actually the day after the top for the oil price. Anyway, so he knows who I am. And he mentions in here, he kind of dogs on peak oil demand, which is my big thing. And so I wanted to kind of respond, kind of pull apart this interview. We're only going to watch the first 10 minutes. So I recommend you guys going back and watching that yourself, the full interview, and supporting Luke since I am responding to him here. But let's go. I'm going to share my screen and I'll refresh because I did put out a new podcast replay of my live stream, the Monday live stream. I'm also going to do that for the Wednesday live stream because I think that was pretty good. We talked about credit markets, collateral rehypothecation, and how, you know, people can understand elasticity of supply of money because the fractional reserve banking, it makes sense that it's highly elastic supply, but there's also elasticity in collateral markets, you know, in securities markets, because these U.S. treasuries can be reloaned, repledged, reused. And the main studies that I found, these date back to, I believe it was 2020. And the average was seven times that collateral was repledged. So that is highly elastic as well. And in periods where you get stress in the system, those collateral chains can shorten, but that doesn't necessarily get rid of the demand, the need for all of that rehypothecated collateral. And so they go out into the main primary or secondary market for treasuries and they buy those up because they still have need for it. They just can't get rehypothecated versions. So that is why the yields go down, because demand actually in the primary markets goes up when collateral chains shorten. Anyway, we will go through that in depth on Wednesday's live stream. So you guys can go back and watch that on Rumble or YouTube. I'm live streaming there again. So make sure if you're watching over there, like the stream, comment, make sure you're subscribed, and also live streaming on Twitter. So you can go back in my feed, my account, at Ansel Lindner, and find Wednesday's live stream that is on there as well. But anyway, okay. This is the website. Subscribe there, free account. You get the free weekly newsletter and notified when I drop content. If you support me and get a paid account, you can get into the monthly price forecasting competition. It's just a friendly competition guessing the price for the end of the month. And you also can get early access to my blog posts. Those do come out public, but first they drop to the paid members and then they go out public. And then I also do these protons, which are short, professional, premium tier, whatever, for higher paid tier on the website. So check all that stuff out on bitcoinandmarkets.com. I appreciate everybody that supports me over there. Okay, let's check the price here real quick. Hey, what's up, guys? Breaking in on the edit. All of these charts that I'm talking about here, I'll make sure to put on the website, the page for this episode. I believe it's going to be episode 375. So that will be bitcoinandmarkets.com/E375. And I'll also put the links that I talk about later on in this episode up there for you guys as well. That is oil. That's what we're going to be getting to here in a second. But let's check out Bitcoin. We'll put it onto log. And sorry, I should have had this set up before the stream, but we're going freestyle here. Freeform Friday. So a little bit red on the day, but not too bad. Sitting at 26,800. Not at that 26,000 boring level that we were for quite a while. It's a little bit more exciting right now. I do see this is, oh crap. Where'd that come from? This is now looking like some resistance. If we throw on the 200-day moving average, and so this is a little bit busy already, but zooming in, I'm going to snapshot that and send it over to Telegram. Telegram is t.me/Bitcoin and markets. You guys that are watching this on YouTube and Rumble or Twitter, you can always join the Telegram. We're cutting it up. We have 420 subscribers. Woo woo, 420. Trying to grow that, of course. So get on over there and subscribe. And that's where I drop all of my content and charts throughout the day, or whatever I'm thinking about, really, whatever crosses my mind in a stream of consciousness. But this here is the daily chart. Let me get back to the screen. So we're over the 50-day moving average in green. The 200-day moving average is up here at 28,000. That also happens to correlate with where the 200-week moving average is. It's pretty much in the exact same spot. So if we can break that 200-day moving average, that is the next big resistance. And after that, it's going to be right up to 31,000, I think. But we'll see if any of this bullish momentum that from yesterday can be translated. Looks like we bounced off the 50-day this morning. And so that's kind of a good sign that we're having. Let's take a look at some other markets. You know, my content lately has been all about a climax in markets. So this is, let me take these moving averages. This is the DXY. It is off the highs. It got as high as 106.8, and it is sitting at 106.2. Got all the way down here to 105 earlier today. So we'll see if this is the top for the dollar. If not, the top is soon, guys. The top is soon. Let's check out the 10-year. This is another thing I've been watching, of course, with the crazy parabolic move here in the 10-year. And it is down right now to 4.57%. It got as high as 4.68%. And today, this morning, as low as 4.51. 4.51. So it is lower than it was for the last couple of days. We'll see if this is also a top. Like I said, all of these things are putting pressure on the system. And so we will be reaching a top here soon and turning around. I think that this end of Q3 happens to be like the perfect time to put in a top and start everything rolling over. Because if we go into recession in 2024, or even if it is early 2025 or something like that, we will know that we're going into recession because rates will fall. The dollar rates, oil, all of those things will fall going into recession. That's what I'm expecting. Before recession, 6 to 12 months before recession is when you can see it coming. And so that's right about where we are right now. The oil here, 91, got as high as 94.85. So it is quite a ways off of the highs. We will see. We're going to be talking about oil mainly today. So let's go and do that right now. All right. So here is Luke Gromen. He was on Real Vision. Like I said, I recommend you guys go and watch the entire video. We're just going to go over the first 10 minutes or so. And I wanted to share my screen with Telegram so you guys can hear, share screen, share system audio. All right. I hope you are set up now. I think you are. So Larry McDonald, he is the one doing the interview for Real Vision. And Luke Gromen, obviously, here is the guest. Crash or boom, they're talking about the dollar is in an increasingly multipolar world. This first section, though, is all about peak oil. That is what I think his argument relies on. So that is where I'm going to spend most of my time here. It's very reminiscent of Zoltan Pozar. And I think that Zoltan is one of the most overrated analysts in the world. He has this mystique about him, but he's been wrong every single step of the way. And I think Luke has been fairly wrong as well. But like I said, I respect Luke. He's out there doing this type of stuff. I respect Zoltan a lot less because I don't think he is as well-intentioned. Luke is whatever. That's just how I see it. But okay, let's go ahead and play this, and I'll make sure all my levels are good.
Next quarter is really the multipolar world versus the unipolar world. It's so in the book I sat down with James Baker, I sat down with David Einhorn and different figures in the market and in politics, and it feels like in terms of the dollar, everybody knows about this dollar bear thesis around, okay, we've used sanctions and we've used weapons over and over and over again, weapons that probably should be used once a decade are being used 5 or 6 times a decade. And we've built up a tremendous amount of adversaries in the world. In a unipolar world, it's really like from like 1970, well, maybe we're like 75 to 2020 to some extent. The U.S. was really like the sole power in the world. I guess you'd have to say after the 80s. So after the fall of the Soviet Union, where we were really a unipolar world and where the United States was really a strong, pretty much the sole superpower. Now we have a situation where we've got China is strengthened, but also other emerging market countries because of the aggression with the sanctions and the U.S. Treasury. We've built up some adversaries. We're heading toward a multipolar world. Is that your view on it? And how do we look at that going forward in terms of investing?
I do think we're heading toward a multipolar world. I do think a big part of that driver has been the over-weaponization of the dollar and the dollar system through sanctions. But to me, at least as big a part, probably a bigger part, is a realpolitik / geological reality, which is as long as oil and critical commodities are only priced in dollars, we are now in a peak cheap oil world where we're not running out of oil, but the cheap stuff's gone. And so oil prices need to rise secularly on average over time. And as a result, that guarantees that dollar FX reserves will run out.
Okay. So peak cheap oil, and let me try to get to a better facial image for him. All right, that's better. The peak cheap oil, because it's kind of mathematically, geologically priced in that's what we're going to have to do is peak cheap oil. I mean, oil is going to continue to get more expensive because demand is going to continue to increase. I mean, there's lots and lots of assumptions in there. My idea is peak oil demand, where because of, like they were talking there about the dollar, weaponization of the dollar, moving towards a multipolar world. I agree with that. I totally agree with that. But the going away from the dollar is not bullish for any of these people. The reason why the dollar was chosen by the free market is because it worked the best. It functioned the best. In those particular circumstances that the world found itself in, back in the last 75 years, the dollar being hyperelastic, tied to the U.S., gets its confidence from the U.S. backing, that led it to be adopted. And only in that system could these emerging markets go from third world to emerging markets. Could China industrialize like they have? Because China's model is based on the global financial system and the global trade network, the globalization that we had. That day is gone. That's why China's economic model doesn't work anymore, and they're going to break down. So, yes, the weaponization of the dollar is part of deglobalization and going to a multipolar world, but that's not bullish for the global economy. That's why I am in the camp of peak oil demand, because as we go away from the dollar, as we go towards a multipolar world, credit markets will shrink, trade will shrink, economic activity will shrink. And what does that do? We also have declining demographics. All of this stuff put together means we're going to have declining demand for oil. And it might not be at the peak, right? Like the peak in 2019 or 2020, I think was 102 million barrels per day. This year, I think we're at 101 million barrels per day. So maybe we get to like 103, 105, but the peak is very soon. And the whole world is going to demand less oil because the economy is going to slow down and there's not going to be any need. That's why it's demand, peak oil demand. But this peak cheap oil, let's let him talk a little bit more because it's all about the rising demand from India and China and places like that.
Stuff's gone. And so oil prices need to rise secularly on average over time. And as a result, that guarantees that dollar FX reserves will run out. And
okay, he also said that the cheap stuff is gone. That is not the case. So let me go in here. I'm going to share this tab again. This is WTI. We're going to go to a monthly chart if it will load. And we're going to hide all of the drawings. And we're just going to talk a little bit about this. Let me make sure that Telegram is seeing this. Yeah, you guys are fine. Okay, so peak cheap oil. Let's examine. Let's go back to 1973. We had a big pop here from $3 up to $10. And then by 1980, it was up at $40. Now, this era was actually inflationary. This was after 1971, and the peg to the dollar or the peg to gold was broken. The last remaining vestige of any sort of credit sanity was removed, and credit just ran rampant around the world, mainly in the US and Europe and places like that, and Japan as well. But credit expanded dramatically, and that is real inflation. So we did have a lot of inflation. That was the great inflation of the 1970s, and it took us all the way up to $40 a barrel in 1980. But then look what happened. It trended down till 1985. The bottom fell out, and it got all the way down to $10. And it stayed roughly there. I mean, this is the Gulf War shock. It got all the way back up to 40. But then, it got to another bottom in 1998, I believe, November 98, at $11. This is a common time or a well-known time called the 1980s oil glut. You can look it up. I've talked about it on my premium content. This was where, the price went up, so production went up, but demand wasn't there, and price went flat. All right, then we have some more real inflation. This is when China is really getting kicked up, going through the late 90s into the global financial crisis. China is really growing. A lot of the East Asian countries are really booming. There is a lot of credit creation in the world. So this is also actual inflation, and it gets us all the way up to $140 in 2008, followed by crash. Then from 2010 through 2014, the oil price was averaging about $100 a barrel. From 2010 to 2014, then price drops again. Then we're averaging around $50 a barrel from 2015 to 2020. And then 2020 hit zero on the futures markets. That sounds pretty cheap to me, much cheaper than 1980. But I mean, just look at this. 1980, it hit $40. And this decade, it was averaging $50. I mean, yeah, that's higher, but that's not dramatically higher. Then this spike, of course, is COVID, the supply constraints. We had Evergreen Beach itself in the Suez Canal causing a lot of problems in that way. Then we had, of course, the Russia-Ukraine war, tons of disruptions, and it's the sanctions, not the war that caused the problems. It's the sanctions that caused the problems. And price went all the way up to, on this monthly chart, the highest monthly close was 115. Not even up here at the peak of the great financial crisis, and barely over the peak here, this secondary peak in May of 2011, barely over this average of 100. I mean, it wasn't that big of a deal, even though it was a huge deal because they did all these sanctions on Russia. Yet, how did oil only go up to 115? It should have gone much, much higher. Much, much higher. But it didn't. And now we're having this bounce up to $90, and everyone's back on the ultra, expensive oil bandwagon. It's going to $200 a barrel and stuff. I mean, if you just look at this since the great financial crisis and today, which I would kind of take this Russia thing out, at least some of this spike, because it was panic and it was completely artificial, right? It's downward trending since the great financial crisis. Where does Luke Gromen get this cheap cheap oil idea? We've been going downward in price in oil since the great financial crisis. And we probably will continue. Like I said, economic growth is slowing around the world. Demographics are declining. And not like, okay, demographics, they say that demographics are going to, the population of the world is going to continue up until maybe 10 or 11 billion people. I don't know exactly how high it will get, but that's not in the developed countries where all of this oil is being demanded. That population increase is coming 100% from Africa. So all of the oil demanding places are aging extremely rapidly. Their economies are going to shrink rapidly. Their demand for energy is going to shrink. So this is peak oil demand. Because even if let's say the average demand for oil from sub-Saharan Africa is, I don't know, let's just say it's 5 gallons a day. I have no idea what it is, but let's say it's 5 gallons a day. Well, the average per capita demand in Europe might be 50 gallons a day or 100 gallons a day. So you had to bring on a lot more Africans to make up for just one European in that total demand structure. So as the Europeans age and die, as the Chinese age and die, as the Japanese age and die, and the U.S. is only 20 years behind, so we will be there too. So is South America. India is on the same track. Bangladesh is below replacement. So everybody's on the same track. And these are the highest demanding places are aging the fastest. I mean, not the U.S. We're actually the highest demand, I think, but we are aging. And the West and the developed countries are aging fastest. Demand is going to shrink. Okay, enough of that. Actually, no, let's go real quick. Another one here is, this is the EIA website, U.S. Energy Information Administration, petroleum and other liquids. This is weekly U.S. field production of crude oil. And you can see just recently we have spiked here again from about 12.4 million barrels per day up to 12.9 million barrels per day. We're just below the all-time high from February of 2020, which when it was 13.1 million barrels per day. So we're only 200,000 barrels per day below the peak. There are stories about the productivity of fracking wells and all whatever is going down. Well, that could be true, but this is not a geologic reality or inevitability, like Luke Gromen said. This is just a matter of opening up some land leases and getting people in there. There's 6 trillion barrels of economic shale under the United States. So it's just a matter of getting at it. All right. So let's go back.
And when they run out as basically being spent down to buy energy, because energy gets more and more expensive every year and these emerging markets are growing, so they're using more.
Energy does not get more and more expensive every year. We just went over the chart. It's on a downtrend since the great financial crisis.
More and more energy every year. They then all are mathematically guaranteed of heading toward a late 90s Southeast Asia crisis where you have to develop.
Okay, he said that, and they're going to continue growing. No, they're not. That is also a false assumption, because if they're de-dollarizing, they're going away from efficiency. There's a reason why everyone uses the same dominant currency, because of the efficiency of it. The efficiency of pricing, the efficiency of transaction costs. It gives you a way to balance your own currency. If you start using your own currency, you lose all of the efficiency of a single currency, and then your demand drops. Your economic activity goes down. So the assumption that emerging markets are going to continue to emerge and continue to become closer and closer to parity with the largest economies, I think is a far stretch of an assumption. Let me just put it that way. It is an assumption that needs to have some evidence. These countries, well, we'll get into it because this other guy that's interviewing him, he makes a point about that here in a second.
Value your currency after you run out of reserves, you have an economic crisis, a political crisis. And so to me, not only it's a combination of the over-weaponization of the dollar and the dollar system, which I agree 100%, but also this geological reality of peak cheap oil, where it is simply a matter of utmost national security for both the world's energy importing creditors of the United States, the Japans of the world, the Chinas of the world, the Europes of the world, and also the energy exporting creditors of the United States, the Russians, the Saudis, the Gulf, the GCC nations more broadly. They simply can't afford to store surpluses in treasuries whose value is guaranteed to fall against oil and other commodities over time in a peak cheap oil world. Because
okay, see how all the assumptions come back to roost? They can't afford to hold treasuries that are going to fall in value relative to oil. I mean, this is an argument from a coupon perspective. So like the idea that people hold treasuries for the coupon value, but that's not the case. Okay, most big, large banks and money market funds and everything, they hold treasury. They have a value above the coupon. They can use them in repo. They can use them as collateral. They can rehypothecate them 7 times. There is a value, a use value, a utility value above and beyond the coupon. So how do you measure that? I mean, it's very hard to measure, but it's above zero. So even if they're losing value against oil, there's still value in the financial system for them. So this, like, you can listen to this whole video, and I recommend going back and listening to it. They don't use the word credit once that I remember. And this is a global financial system based on credit and elasticity and rehypothecation and fractional reserve. And they don't use the term credit once. So there's definitely a reason to hold U.S. treasuries. And if they get to a point where they can't because they need to sell them to get dollars to protect their currency or something like that, shit's hitting the fan. This is not good for their economy. It's not good for their growth potential. It's negative if this happens, which then what? Affects their demand for oil and energy. It goes down. Peak oil demand.
It just means they are on a guaranteed highway to a global Southeast Asia crisis, which is simply not in their interest and something they're not going to abide. And so I think that's really been sort of a turbocharge alongside these over-weaponization of the dollar over the last 10 years, as you've noted.
All right, let's go to the next question.
In a room in Beijing, because central planning is dangerous, right? But in some ways, we have central bank planning in the United States, right? So we've taken 5 million jobs out of the United States. We've decimated the Rust Belt. We now have a massive dependent class of human beings that.
Okay, so notice these bad things he's saying, that we decimated our Rust Belt, our manufacturing sector. We have all these dependent people. We have cultural problems in the United States. Guess what that is? That's the price paid by the global reserve currency. It's an exorbitant burden, not an exorbitant privilege, as Luke Gromen and others will have you believe. Being the global reserve currency is extremely expensive and taxing to the home country. Not only that, but the U.S. also dominated international institutions and international trust and international rules, forming the UN, the IMF, the WTO, the World Court, NATO, on and on and on. That's expensive. And how did we pay for it? Well, we paid for it with millions of manufacturing jobs, horrible cultural problems, the gutting of American culture and American industry, but not completely. That's another thing that brings up another point, is that the U.S. is still the second biggest manufacturer in the world. I remember watching a video of, I think it was South African president or prime minister, and he was saying, "Oh, well, why do we need the U.S.? Why do we use the dollar? Because they don't make anything and da 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 da." The U.S. is still the largest producer, or the second largest exporter in the world, second largest manufacturer. We're the largest consumer. Everybody wants to sell to us. And remember the old adage, the consumer is always right. It doesn't matter if China is the biggest manufacturer, because who's going to buy it from them? You can't substitute 300 million Americans for 1 billion Indians. They're still going to demand less. You have to have demand, or else you don't need that much supply. And then what happens to the Chinese economy that's built for this export model to the United States specifically? It falls apart. And then what happens to their demand for oil? It goes down. So there's a cost to being the global reserve currency, and it will get lightened. The load will be lightened if the U.S. backs up. This also, actually, before I keep going on here with Luke, this reminds me of a video I just watched. I just found it. I think the guy's name is like Dark Age Theorist or something on YouTube. I did share it in Telegram. He's talking about the fourth turning, and he dives down deep into it and does a bunch of graphical representations, and I thought it was fascinating. So you guys can join the Telegram and find that link. But in there, he was talking about, the fourth turning is usually an external crisis. And the second turning is usually an internal crisis. So you have like a social, cultural crisis and then an external crisis on the fourth turning. I think the external crisis for the U.S. this time, and maybe for everybody, instead of being a world war, it's going to be the U.S. withdrawing from the world. So we have seen that in the failure in Syria. We've seen that in the pullout from Afghanistan and Iraq. We see this from the failure now in Ukraine, people losing confidence in American leadership and American hegemony. But they don't understand what it's going to be like when America isn't the leader of the world. So I think that's going to be the main external conflict, is between two factions in the United States. That is the Davos crowd and the populists. So really, Biden and Trump are very good examples of both of these sides, where the globalists want to keep the U.S. involved in the world, but the populists want to be non-interventionist and be isolationist. That is American culture. That's American history. So there is a tug of war going on between these two factions. And I think the populists are going to win, and the U.S. is going to withdraw from the world. And that's not good for international business. That's not good for trade. It's going to collapse around the world, and on and on. And that's what I've been talking about. So, okay, let's get on to Luke Gromen.
Fathers wake up in the Midwest that 20, 30 years ago, their grandfather woke up and really was proud and represented the family. And now we have people that have been displaced by technology, by cheap labor overseas. The good news is we've raised the standard of living dramatically in the developing world.
Notice the word he used, we've. And that's true. The U.S.-led order has boomed with credit expansion and technology that came from American inventions and stuff. And I'm not, it sounds like I'm just a real big woo-woo U.S. or something like that. Well, I am. But anybody that comes here is going to be more successful. So it's not like a race thing at all. Just look at the most successful immigrants, I think, are Nigerians that come to America. So it's not a race thing at all. But the Michael Beckley, he wrote Unrivaled, and he said something in that book that was fascinating to me. So he said that the same person living in, say, Kenya, and you take them and you put them into Geneva, Switzerland, that same person is going to be more productive in Geneva, Switzerland than in Nairobi, Kenya, just because of the environment that they're in. And so that's also why the U.S. is great, because we have this environment that you can take somebody from Nigeria and plop them in America and they become hyper successful. That's just how it is. And it's usually a network effect also. So the bigger it gets, the better it gets. The bigger it gets, the better it gets. So I don't know how I got on that, but let's get back to this.
Young people in India today in a call center are making, maybe 10 to 100 times more than their great grandparents. And so haven't we created a new class of energy consumers? So we because we've raised the standard of living in India, raised the standard of living in Vietnam, but at the same time, if you look at the capital expenditure investment track from 2014, where we were, if we were on that same pace to today, we probably would have spent an extra $2 to $3 trillion on oil and gas and metals and all the things that we need for the world. Since 2014, the global population's up about 600 to 700 million human beings. Okay.
Okay. So I didn't get this the first time I watched it, but he's saying that the investment that we were in before 2014, the investment track was, if we would have kept along those track, investing in mining, oil, fracking, and all this stuff, we would have had invested 2 trillion more than we have. We actually have, the investment has slowed way down in all of these things. But we have this population in the world that we have created more consumers of this stuff. Now, most people will think about that and they'll think, oh, there's a crisis coming. But the way I look at it is the market knows more than me. The market knows more than me. And if the market is slowing down investment, whether it comes from government regulation, whether it comes from hard economic times, whatever the case, there is a reason for this. There's a reason for this lower investment. And most likely it is because people won't be able to afford it in the future. So it's already the investment track that probably is like 5-10 years ahead of time. That's a leading indicator for global demand. And it's telling us that global demand is going to go down, or at least rapidly slow its pace, maybe even go down. So that's how I look at it. But these people, they look at it as this is a market failure of some sort. Somehow the market has failed and they need to get in there and let's extrapolate to the absurd degree where everybody can have their own currency and the dollar goes to zero. It just doesn't work like that.
And so there's a billion people in India that don't have air conditioning. There's a billion people in China that don't have an automobile. Isn't this a recipe for a problem? Because like you said, those resources that we need, that the investments in uranium, in copper, in oil and gas, we need those investments to find those minerals and green metals and oil and gas. But we've raised the standard of living globally. This sets up a pretty toxic cocktail based on what you just told me, before about the balance of payments.
It does. From multiple standpoints too, right? If you look at per capita oil consumption, I'm going to preempt him here again, but the bad cocktail is higher demand but lower supply. It does not enter their thought process that these places are going to have lower demand. We've quote unquote raised them up on this credit market on free trade, buying all their exports. But somehow the U.S. is going to go down and they're still going to be continuing to raise their demand and standard of living and all this stuff. No, the thing that's going to break is their standard of living, not the oil market. I mean, these places won't be able to afford $200 a barrel oil. I don't know how if oil goes to $200 a barrel, there's something called demand destruction that happens. Think about it, just India here. If oil goes to $200 a barrel, how much demand destruction is going to come from India? They're not going to just pay it or try to pay in rupees or whatever. Their economy is going to be destroyed to a point where supply can come back in line with demand. So the give is not the US dollar standard. The give is the demand out there in the economy. That's the give. Demand destruction. In India, it's 1/15 of the United States. In China, it's 1/5 the United States. China is already the biggest oil importer in the world. They surpassed us 4 or 5 years ago. And so I, from time to time, read about peak oil demand, and I laugh because, number one, human demand for energy is infinite. It's a question of price. If I could fly a G5 on vacation everywhere and take a helicopter everywhere I went, I would. And if energy was free, I would do that. So would everybody else on the planet. So it's a question of rationing infinite demand for energy with price.
Okay, I think he's talking about me here because I don't know if other people are talking about peak oil demand. And like I said, I have interviewed him in the past during a spike in oil prices. So I know he's aware of me. I don't know if he's aware of my content or anything, but he apparently laughs at this peak oil demand idea and then proceeds to talk about infinite demand for oil. Okay. I mean, he does try to save it by saying it's a function of price there at the end. But yeah, okay. If price can go low enough, there's the infinite demand. But that's not where price is. We live in the real world. This is talking about where supply meets demand, not just a hypothetical infinite demand. This also brings into the discussion about the inelasticity of demand for oil. So the idea is that oil, the demand curve is relatively inelastic. So price can go up, but you have to continue a certain level of oil consumption. You have to continue that because if you don't, then it's going to massively affect your economy and all that stuff. So it's relatively inelastic. It's not like the price of oil can go up and your demand gets cut in half. No, your demand usually will get cut by like 5% or something. So it's relatively inelastic. However, if it goes up high enough, that it will come back. Will be highly elastic if the price goes high enough. But also there's all sorts of talk about the shifting of the demand curve. So demand destruction would be the shifting of the demand downward. The entire economy goes into hard times. It literally, the economic activity goes down and it has less demand for oil. So the demand curve shifts downward. So when I talk about peak oil demand, I'm talking about pretty much the farthest to the left that you can push the demand curve. What's up, guys? Breaking in once again on the edit. This is like my third take trying to get this clarification right. So I did misspeak there. I meant to say that the demand curve is as far right as it can be, and it can only shift left. And I understand that might be confusing to some people. So I went ahead and made two quick supply and demand charts. They will be on the page for this episode, so /E375. And I do one for my theory of peak oil demand. It's very simple. The demand curve shifts to the left due to demand destruction and bad economic times and deglobalization and depopulation and deflation and de-dollarization and all of these things. So the demand curve shifts more quickly to the left than supply can adjust downward to keep prices relatively stable. So prices should tend to go down over time. Now, peak cheap oil, Luke's theory here, I tried to make a chart that I think matches with what he's describing. And in his scenario, demand is going up. Demand curve is shifting to the right because more customers are coming into the market because of all these other countries that have infinite demand. So demand is shifting to the right, which will make prices go up. There's also another difference here with peak cheap oil, and that is that the supply curve has to approach zero quantity at some arbitrary price that is too cheap to produce. And I just picked $100 a barrel to make it simple, a round number. But if the price goes under $100 a barrel, then there's going to be zero supply on the market. That doesn't even make sense to how these things would work, because if the price is falling, demand is going to be rising. And so it doesn't make any sense how you get to zero quantity supplied. So that is just a very technical reason here that I think this chart makes much more clear that there's just no way for this to work. if cheapness, the peak cheap oil, because there's no cheap oil left, that doesn't matter because we can never get down to some arbitrary level that's too cheap to produce. What does that mean? It means that peak cheap oil, the cheap part, doesn't matter. It is at its heart a theory of rising demand, not a theory of any sort of, geological cheapness, arbitrary cheapness level, because we can never get there anyway because demand is rising. Where my theory is that demand is going to fall. So these are completely at odds with each other. But anyway, I hope that makes it more clear. Check out the website and those charts, and let's get back into it. That's where we're at. And everything from here on out is going to force that demand curve to the left. But he laughs because there's infinite demand for oil. I mean, such a simplistic response. It's like he doesn't even say supply and demand. He says supply, or no, he says demand and price. It's also demand and price through time. So the amount of oil demanded at $100 a barrel in 2014 is going to be different than the amount of oil demanded at $100 a barrel in 2023. So it's a function of supply, demand, and time and situation out there in the economy. So, okay, that's that. Let's continue.
Historically, that's been done via the dollar, effectively, right? Oil was only priced in dollars. And so, again, here too, it ties back to that initial point where if the dollar strengthens too far against the Chinese yuan or against the Indian rupee, they energy gets more and more expensive. They reduce their usage. By creating this...
Bingo. Peak oil demand. He said it. He said it there. Peak oil demand. But now he's going to laugh at himself.
Energy gets more and more expensive. They reduce their usage.
This gigantic middle class. So those two, like that I said, are 1/15 and 1/5, India and China, respectively, of per capita usage of oil in the U.S. or of the U.S. Excuse me. That's 35% of the world's population, and they have infinite demand for oil, just like every American does. They, people, and so they're.
What does that even matter? That they have infinite demand? They have less ability to buy it.
This is why I think the energy situation is a forcing factor to multipolar and to the de-dollarization of global commodity markets. Because if you're China, you can very clearly see how China has been.
Okay, before he says that, the de-dollarization of global commodity markets, if that happens, economic activity will go down because there's a reason why you use $1 or one currency, one money to price everything, because it's more efficient that way. You not only open yourself up to transaction costs and a bunch of different prices and slippage, but you also open yourself up to currency attacks. So, like, let's say you're Vietnam. What do they use in Vietnam? I don't even know the currency. Let's say you are, what's another smaller country? I know the Thai baht. So let's say you're Thailand and you're trying to use the baht, and China doesn't like something that you did politically or geopolitically or whatever, and they attack the baht. In that case, you don't have the dollar to fall back on, the global reserve currency. You open yourself up to all of these other problems. And on top of that, do you think that a government bond denominated in Thai baht is going to be as liquid, is going to have as much utility in the global financial system than a U.S. Treasury? No, it's not. So you lose out on that utility. You lose out on access to credit. You increase your transaction fees and your slippage, and your vulnerability to Forex attacks. Is pretty much the dumbest thing you can do is to try to go away from a global reserve currency voluntarily. Of course, there will be involuntary here, and that is going to have the same sort of effects. It's going to be negative. That's why the peak oil demand. The demand curve can only go in one direction, and that is to the left.
Working to set up the infrastructure to pay for energy in yuan. And people say, well, who wants to take yuan? We've seen, well, the Russians are taking yuan, Venezuelans are taking yuan, the Argentinians are not taking yuan. There's a lot of different commodity. The Australians are taking yuan, the Brazil. So that if you want to turbo.
Okay, let me share this one. And this is the Wolf of Wall Street. I think. No, sorry, Wolf Street. Wolfstreet.com by Wolf Richter. Came out 1 January 2023, and he's talking about U.S. dollar FX reserve levels here. U.S. dollar share of global reserve currencies. Oh, it looks like it's going way down, right? From 66% in 2014 down to about 59% in 2021. I think this did hit a low, like a multi-decade low there in 2021. But if we come down here a little further, U.S. hegemony. Euro is a distant number 2, yen a super distant number 3. So now we plot this against the other currencies. Like he's talking about the RMB or the Chinese yuan. Look, it's non-existent. And also, this includes things like Hong Kong holding RMB or Taiwan or, like these very close trading partners. So also the IMF tracks usage in international transactions. And the RMB is like 1% or maybe it's 2% now. But they also count transactions to Hong Kong as international use. So really, if you did X Hong Kong, it would be like probably 0.5% of global transactions are done in RMB. And look, this is 2020, written on January 2023, January 1st, 2023. Sorry about that. And now if you plot it against these other currencies, the US dollar doesn't look so bad. And it's going back up. It's going back up in 2022 when we had the big price spike. Remember, we had that huge price spike in March and into May of 2022. And the US dollar as FX reserves is going up. This is exactly contrary to what Luke Gromen is saying. Also, found this article. This just came out today from Reuters. U.S. dollar share of global FX reserves stays flat in Q2, according to the IMF. The U.S. dollar share of global currency reserves reported to the IMF was 58.9% in the second quarter, unchanged for the last 3 months, blah, blah, blah. Claims in U.S. dollar rose 0.8%. to 6.5 trillion, and it's been at 6.5 trillion for a long time. So this is the amount of U.S. reserves, forex reserves held by these countries is not going down, people. It is completely empirically. Luke Gromen has been disproved right here. Congratulations.
Charge per capita consumption of oil and other commodities. The single best way to do it is you start to form a middle class, and then you gain the ability to print your own currency for commodity import.
Okay, I'm not going to listen to that because it's kind of the whole basis of his argument has been debunked now, so we don't have to watch the rest of that. All right, guys, thanks for joining me. Happy Friday. Hope you guys have a great weekend. Check out bitcoinandmarkets.com. Sign up, become a free member, become a paid member, and help support my content. Join the Telegram, t.me/bitcoinandmarkets. Check out the YouTube and the Rumble. If you're watching over there, like, subscribe, and I'll see you guys on the next one. Bye.